Welcome to this week's episode of Accredited Investor Markets Radio. Each week, we speak with you about investing in alternative assets. Unbiased and beholden to no one, Accredited Investor Markets Radio does not accept advertising from any investment firm or financial advisor. Accredited Investor Markets Radio is the spoken word sister of AccreditedInvestorMarkets.com, the internet's most comprehensive and unbiased educational resource about crowdfunding, angel investing, venture capital, private equity, private shares, and other investment classes beyond publicly traded stocks and bonds.
Hello everyone, welcome to Accredited Investor Markets Radio. I am your host, Christopher Cahill. Later on we'll have an interview with Heather Lopes, co-founder and chief strategy officer of EarlyShares. I think you're going to enjoy this interview. Ms. Lopes has a lot of energy, which goes with a lot of knowledge. But first, a few observations on what's been in the news. The Chicago Sun-Times, in late October, reported that France has reclaimed its wine title. You probably didn't know, I certainly didn't know, that France had lost the wine title. But evidently, it's a neck-and-neck race among France, Italy, and Spain. Italy's winemakers have outproduced France's winemakers for the last 2 years until the 2014 harvest, which saw Italy's wine production plunge 15%. So Italy's loss is France's gain. Spain leapfrogged France into second place 2 years ago. But its production fell last year. Total world wine production is set to fall 6% in 2014. Well, now, if they had baseball in Europe, of course they do, but not on a big level we have it now. I mean, we in the United States, we have Major League Baseball games. If you go to the game, you'll end up cheering for digital representations of sausages running around the bases, and you're cheering for one set of sausages over another set of sausages. Well, in France, Italy, and Spain, those would be winemakers, and the songs would be intensely nationalistic. Well, let's move on to music. We've talked about wine. We're not going to talk about women today, but we will talk about music. Spotify UK is sort of like Pandora, which is sort of like Beats music, which is sort of like iTunes. These are ways to get music without the inconvenience of actually buying anything physical. Just try asking a young person what a 45 is. If they don't say it's a gun, well, they're not going to say it is a way of delivering music to people. Anyway, Spotify UK has had a presence, and they have made a profit, but not much profit. According to privco.com, which I've cited before, it's an invaluable source of information about companies and their numbers. Spotify UK's revenue growth did occur in the last year. It rose 42% year on year. Spotify is, by the way, a subscription service. They don't do it by selling ads that go with your music. They do it by having you subscribe on a monthly basis. However, Privco notes that the high increase in subscription sales was driven by a massive discount for students. Of course, students need a massive discount, but that also makes your profit margins rather thin. Advertising revenue has been a very, very small part of Spotify UK's earnings. So barely £2 million in earnings from Spotify. And Privco opines that unless Spotify is able to restructure and especially reduce its royalty costs, it's never going to make very much money. Copyright holders, including publishers, recording artists, and record labels, receive approximately 70% of every pound or dollar, I suppose, in revenue Spotify makes. Pandora, which I mentioned earlier, is still unprofitable. Well, on October 25th, by chance, the Wall Street Journal wrote an article about iTunes entitled A Sad Song for iTunes Sales. The article was written by Hannah Karp. So the growing availability of cheap music, it seems, you can just open up your iPhone and get it, may be sapping demand for digital downloads, even those of Apple. Not everything Apple touches turns to gold. Music sales at Apple's iTunes store have fallen 13 to 14% worldwide since the beginning of 2014. Plummeting download numbers help illustrate, or perhaps gave Apple the reason, to purchase Beats Electronics, or at least their subscription service for streaming music. Apple paid $3 billion for Beats Electronics. Why would they do that? According to Ms. Karp, Apple is rebuilding Beats Music and plans to relaunch it next year as part of iTunes. So Beats is a subscription service, about $10 a month. Apple is trying to add that into the mix, although one might expect that they're going to face the same profit pressures that have plagued Spotify. That's me editorializing. I just don't know. But that's what I surmise from reading the two articles together. It's a good idea, by the way, is to read more than one treatment of the same kind of thing. One thing that Ms. Carr pointed out that I did not know was that in the U.S., recorded music sales are down nearly 50%, their peak in 2000. They've been essentially flat for the past few years, but 14 years ago, twice as much recorded music sales in the United States. Well, so maybe wine and women are doing okay, depending upon what country you are in wine-wise, but music's not doing okay. The pie seems to be getting smaller. I'll leave it to you as to whether that's an aesthetic judgment or if it really does have to do with the growing availability of cheap music. Well, that should do for now. Let's get to the interview with Ms. Lopes. We have with us today Heather Schwarz-Lopes, and I'm personally very delighted to have her with us today. Heather is an experienced executive with a long track record, 16 years of success in the financial services industry. However, that is not why she is with us today. Heather is co-founder and chief strategy officer of EarlyShares, a leading equity crowdfunding platform. Through this, Heather enables accredited investors and other individuals to capitalize on new investing and capital raising opportunities which are presented by the Jobs Act and related regulations. I guess as I introduce the topic today, I would say make the observation that many people, even non-tech types, even older types, have grown used to moving large percentages of their nest egg around the internet and the cloud, perhaps making trades on Charles Schwab or something more sophisticated than that. So it's not that it's online, but we have these new animals called investing platforms. And I wanted to ask Heather about that along our theme of nuts and bolts, fees and functions with regard to equity online platforms. So Heather, how do you answer the question, what is a platform?
So a platform in its simplest form is almost like a Match.com. And the two sides of the audience, we've got a interested set of investors that are looking for opportunities in early stage finance and real estate opportunities and private placements and fund options. And then on the other side, we have entrepreneurs, we have real estate developers, anyone that's looking to raise money that has gone through our vetting process and criteria, that is looking to leverage these new securities regulations and technology platforms like ours, like EarlyShares, so that they can hopefully make a connection between the two groups.
Okay, and being a little more specific, it's not limited to equity investment, right? I mean, there's also debt investments.
Yeah, there's debt investments, it's equity, there's different industries. I mean, we've got a wide variety of industries and verticals on our platform, and we consider ourselves as industry agnostic. So what we're really focusing and looking at are the opportunities, are the management teams and the people that are truly behind these endeavors or these projects. What kind of uniqueness, what really is special that defines them, that makes them stand out. And so we have a long list depending on what type of industry that they're in that we put them through, and that's part of our general criteria.
Well, okay, but if somebody was particularly desiring to look into opportunities in aquaculture, well, maybe there's a platform out there that that focuses on agriculture largely, or even smaller on something as specialized as aquaculture investments, for example.
Sure. I mean, you're going to see a lot of different players in this space. So you've got platforms that are focusing on the type of crowdfunding. So you've got equity, you've got debt, like you mentioned. You also have a huge reward space, so the Kickstarters and the Indiegogos. There's a huge donation space, and then you have subsets of all of those four categories. And within those subsets, they look at stage of company or stage of the offering, at the size of the offering, and at different industries. So as you mentioned, aquaculture, there may be a specific platform that only focuses on aquaculture. There are platforms that we've seen that only focus on real estate. I've seen platforms that only focus on social impact investing. I've seen platforms that only focus on solar and new energy type of products and innovations. So because this space and this industry is just it's so big, and this is truly going to be a very disruptive way and a transformational way of conducting these early stage or these private placement offerings, just taking what we've been doing offline for the past almost 100 years and moving that onto online and taking advantage of these huge networks. You're just going to see a huge movement going on to these types of mechanisms and funding platforms.
Yes. Well, I can imagine. The costs of entry are not huge in the sense that you don't have to, build a racetrack or a hospital or something. You just have to get some talent together and make an investment. Yeah,
cost of entry to build a platform, you're right, it's not like building a hospital or a planned community. However, it is costly, and it's more than just building a beautiful website. Mm-hmm. And I think what a lot of people overlook when just looking at this industry on the fringes is that this is investment banking. This is a financial services business at its core. And if you look around the wrapper, there's a huge legal component, and there's a huge technology component, and then you've got a huge marketing component. So when you factor in all of those different aspects to truly build a compliant, a secure, a presentable a platform that is built to transact and built to be scalable, it is quite expensive.
Well, I guess then we should say that it had better be more than a beautiful website.
Exactly.
More than just a pretty face.
There you go.
I suppose just to make a distinction that maybe some of our listeners are familiar with, but some not as familiar with. You mentioned rewards and donations, but you also mentioned private placement. For me, those are two different worlds. Rewards and donations are currently what gets, quote, crowdfunded, end quote, meaning anybody can do it. You're not really buying anything. You're contributing, whereas private placement, you're actually purchasing securities, be they of the debt kind or the equity kind, and that is more heavily regulated, right?
Oh, 100%. There's hardly any regulation within the reward and the donation space because there's no economic upside, there's no profit potential like you have in the debt and the equity space. So if you want to buy something online and you want to get the coolest new iPhone cover and be one of the first people to do so, or support a band or an artist, that's great. But if you actually help fund entrepreneurship and help be a part of innovation but actually get rewarded for it potentially, then that's where you need to play in the equity and the debt space.
And accredited investors then, under the Jobs Act, have greater access to investment opportunities, and these platforms facilitate that very access.
Yes. So looking at the current regulation and what the SEC has promulgated is that only accredited investors that have gone through the process of verifying that they are accredited investors can actually participate in these openly marketed and solicited type of offerings. So there's another part of the Jobs Act that's referred to as Title III, which is it's a true form of equity crowdfunding, and that opens up the private placement market to anyone. It's regardless of income, regardless of your net worth. And so the SEC is still trying to finalize those rules and regulations. They came out with a proposal back almost a year ago, and that proposal was something like 586 pages long.
Yes.
Not sure if anybody listening to this read the whole proposition. I read it a few different times, but a very complicated way of raising money. But there's also some safeguards and protections for investors that don't meet that accredited definition, that accredited investor definition. So you're talking about two completely different markets.
I think I'd rather read the tax code, and before that I'd rather read the Mishnah and the Babylonian Talmud than to read 586 pages on crowdfunding. So Heather, can people who are not accredited investors go on and window shop? I mean, is it a situation where they can look where they can look but they better not touch, to quote Bruce Springsteen, or can they not look at all when they go onto a platform such as EarlyShares?
Yeah, that's a great question. So the way that the rules were designed is that issuers or entrepreneurs, anyone looking to raise money, they can utilize the full benefit and the full flexibility of general solicitation and advertising and market to anyone. The big caveat is that you can only accept subscriptions, commitments, and funding from verified accredited investors. So that's something that as a platform at EarlyShares, we help our issuers with. We help verify the investors to make sure that they do meet that definition of an accredited investor. And so just for the benefit of the audience, the definition of accredited investor is someone that has made $200,000 an individual over the past couple of years and expects to make that money moving forward, or a couple married filing jointly that makes at least $300,000, has made that for the past couple of years, has the expectation of making that ongoing, or you have a net worth of $1 million excluding your primary residence. So we have about 7 different ways of verifying that accreditation. And it's, again, something that we offer as part of our services and support for the companies that are raising money on EarlyShares.
If you're a platform builder, again, we're talking from the perspective of investors, but how is an investor supposed to understand how platforms come together and whether platforms contract with other entities to do the interesting array of things you've been suggesting? And lastly, how do these platforms see themselves making money?
So 2 separate points. So how a platform comes together, obviously a lot of components of technology, of compliance, financial services and marketing, all wrapped together in a nice pretty bow. But platforms don't do it on their own. So we work with several different partners that offer a lot of services that complement the business that we're doing and the transactions that are occurring on the site. For example, and this can lead into another discussion about due diligence. We work with a company very closely called CrowdCheck, and it was a company that was solely founded to do this objective, third-party, independent due diligence on companies utilizing new regulations, utilizing 506C.
Issuing companies.
Issuing companies, exactly.
Yes.
And so Sarah Hanks, the CEO and founder, she's a former SEC attorney, and she completely understands security regulations and understands that there could be a very big opportunity for fraud in the market. And when you think about, okay, now that people can raise money in a very public way online utilizing the Internet, the first reaction that I get from somebody that's not very familiar with our process is, wow, that sounds like there could be a lot of fraud embedded. Well, when you look very close into what types of checks that CrowdCheck does, it's very impressive, very difficult to create a fraudulent transaction and bypassing or going through her process. So everything that she does, it's very similar to a legal opinion letter, or at its most basic form, it's just like getting an appraisal on your house or any other type of property. So she's checking to make sure that the issuer is indeed who they say, that they have the intellectual property that they're claiming to. So she's doing that patent check and copyright check, that they actually own their website. There's a concept. That they filed all of their forms accurately with the state, that they're formed properly, that they're authorized to make the raise. The cap table is right. I could go through probably 100 different points. At the end of the day, I mean, her process is truly comprehensive. There are other providers that we partner with, either from an escrow perspective, because we utilize escrow with all of our offerings.
How do you use escrow in each of your offerings? What's the mechanics?
So our offerings, depending on how they're structured, they typically have a minimum amount to close and a max offering, what they've been authorized at a corporate level to raise. So until they hit that minimum, which is the absolute minimum amount that they need to actually grow their business and take them through funding or take them through their operational or growth needs, we set up an escrow account where investor funds, once they make an investment commitment, sit in escrow until that minimum is reached.
And if it's not reached, it goes back to the putative investors.
Absolutely,
Oh,
without any fees. And it's not an escrow account that EarlyShares manages. We work with a couple different escrow providers. So again, it's arm's length, it's objective, third party, just to make sure that there's no questions as to where funds are flowing.
I don't know how we're going to end up with wacky schemes like the producers if this becomes the industry standard.
Yeah, we're ultra conservative here, and we take a compliance first approach. And I always joke around, but it's very serious. Truth is best said in jest, that we are jail adverse at EarlyShares. So we take investor protections or platform protections and securities very seriously.
Okay, you mentioned the word fees. Now, naturally, everybody works for money. So how do you get your fees, and how does that affect what the accredited investor pays?
Sure. So there's no cost to be an accredited investor on our platform. So pretty much we work with companies looking to raise money in a few different ways. If they want to leverage our technology and they want to create more of a reach to new potential investors, then they work with us in a direct posting fashion where they pay us a flat fee and they utilize everything that we've built within the platform. We also have a model where we put together our own special purpose vehicle where we pre-identify exactly what the underlying investment is going to be. We're not forming any blind pools. So we will say that this fund is set up exclusively to invest in this shopping center, and we're accepting fund minimums at increments of $5,000. So for $5,000, you can invest in a CVS, or you can invest in a Walmart-anchored shopping center, or the next financial technology company that is interesting. And so what we do is that we pull together investor commitments, and then we turn around and make a single investment into the issuing company. The issuing company likes that because they're only working with one shareholder, and then just from an administrative and reporting perspective, investors, they like that as well. Plus, it becomes an access point, an affordable access point into some of these offerings where normally the minimums are $100,000 or $1 million. So it's a great tool for investors to diversify.
Isn't that one of the great promises of the Jobs Act, is that you'll have these smaller increments that were just not at all available before?
Yeah, absolutely. And it's about access. And then so the third way that we work with companies, we have a broker-dealer relationship for larger offerings, so for $10 million plus with national securities, and we are also in the process of becoming our own broker-dealer.
Ah, great.
Yeah.
Well, you've already answered this to a pretty large extent regarding EarlyShares, but without naming names, maybe you can comment on how platforms do differ from one another in the due diligence area. I understand there are some platforms that are more like bulletin boards and less like vetting factories.
Yeah. So if you look at the spectrum within funding platforms, you do have on one side bulletin boards, which becomes it's simply put the Craigslist of private placements. So very low barrier to entry, zero due diligence, and it's buyer beware on everything that's posted online. And then on the very other side of the platform, you have traditional venture capitalists and hedge funds that have been operating within their specific niche or industry or place in the market that are just now utilizing general solicitation and marketing as a way of finding additional investors to co-invest with them, or as a way to identify new interesting opportunities that they could invest in. And so obviously they would have their own pretty comprehensive and intensive due diligence. What we're doing is somewhere in between. So we're doing that objective check, but we're not going into the actual business proposition of these issuing companies to put our stamp of approval to say, you know what, this is a really good quality offering. We're going to invest in it. We believe in it. That's not really what we do. We leave that up to our audience and our marketplace of investors to give our issuers that validation and the funding support. So we fall someplace in between that spectrum.
No, very, very well and clearly put. So I guess to get back to an earlier theme, when I want to sell subscriptions, I should say when I want to oversell subscriptions to my new musical, I want the bulletin board approach and not the EarlyShares approach.
That's right.
Well, then let's talk a little more expressly about fraud risks. You are managing, EarlyShares is actively managing a whole array of fraud risks, but are there some that are unmanageable or some risks of nearly that nature that are unmanageable?
Unmanageable risks. I mean, you always have the risk of market fluctuations and then business risk.
Yeah. Isn't that the same thing as fraud? Oh wait, I forgot.
No.
I'm not a plaintiff's class action lawyer. I forgot for a moment. I'm a banker. I'm a restructuring advisor. Sorry, my personality slipped. Okay, so what kinds of risks are there out there that you cannot deal with through a due diligence process such as yours?
I mean, again, we feel like we've reduced as much as possible, as much as a platform can, that fraud risk. But just looking at other risks, I mean, you're always going to have the market risk, whether it be just general businesses raising money or musicians, artists, or real estate companies. And then you've got business risk. So looking at growth stage companies that are early on in their business cycle, I mean, they're inherently risky. And so one of the requirements that we have on the platform and one of our vetting criteria is that we cannot be your first round of funding. So we require issuers to have a founders round, a friends and family round, and some sort of outside investors or investment round. And then we come next. So we feel like by implementing that we've filtered out a lot of very, very risky opportunities.
I'm never going to get any funding for that musical, that's for sure.
No, you're not.
No.
and unless you have a great celebrity in it, and then you can do something on Kickstarter, just like Veronica Mars did, and you'll get $5 million.
Well, but in truth, couldn't that be a strategy, not for my fraudulent scheme, but rather if you are putting together an exciting new musical and you do have a celebrity worth paying attention to, you might start with a Kickstarter campaign and get excitement going in the larger world, and then move on to some of these more conventional rounds.
Oh, for sure. And going the reward route is a great way to get the crowd validation. So if you think your idea is good, or your project or your production is good, but you're just not quite sure, and you don't want to go to your circle of friends and family and your sphere of trust, then put it on a reward site, and of course if it's applicable, and see what happens. See how much traction you get. There's a lot of virality with those types of offerings, and you can find out pretty quick if it's a good idea or not.
It's like a really serious focus group because money's changing hands.
Oh, absolutely. And so one of the other points that I wanted to mention regarding risk is that you've got this thing called the power of the crowd. And that's really powerful because it's no longer that one-on-one relationship where the person raising money is selling to one person at a time. You've got this one on a lot, a very many relationship. And those many can talk amongst each other very publicly. So the crowd is an excellent way of sniffing out any kind of bad opportunities, any kind of fraud, or anything that doesn't really make sense. And we've already seen incidents of this on Kickstarter and Indiegogo, and those platforms immediately took those fraudulent offerings down. And then on the flip side of that, you look at equity crowdfunding around the world, and we're kind of late to the game. I mean, the true form of equity crowdfunding, Title III to unaccredited investors, hasn't even started yet. But Australia, it's been going on, I think, 8 or 9 years. In the UK, it's been going on 2 or 3 years. 0 incident of fraud.
Oh,
so again, the power of the crowd, very important.
Very interesting, the comparative perspective. So I'd like to close with, for the benefit of our listeners, asking you whether you can identify a professional group for platforms that has public information that would be helpful to accredited investors who are interested in learning more.
Oh, yeah, absolutely. There's a handful of them. So crowdsourcing.org, they're a really good platform, and they put out a lot of good information. Crowdfunding Insider, CIFRA, the Crowdfund Intermediary Regulatory Advocates, it's a mouthful, a lot of resources in education. And, there's the CFPA, the Crowdfunding Professional Association, and we're seeing new organizations and associations popping up a lot.
Well, all right. Heather, Schwarz-Lopes. I anticipated you would be fun to talk to, and of course you were. Ms. Schwarz-Lopes, we're very glad she came on today, and thank you, Heather.
No, thank you. It's my pleasure. I'm happy to come back anytime.
Heather Schwarz-Lopes is co-founder and chief strategy officer for EarlyShares, a leading equity crowdfunding platform. Thanks again, Heather, and thank you all for listening, and we look forward to doing this again sometime very soon.
Thank you for joining us. If you enjoyed this episode, you can subscribe through iTunes or Stitcher, or you can download our app from Libsyn. You can also listen right on our website, www.AIMkts.com. Each week, Accredited Investor Markets Radio brings you news and education about investing with a focus on alternative assets. To see a short-written summary of this episode, go to www.AIMkts.com. Accredited Investor Markets Radio is a production of Financial Poise Radio Productions, LLC.